Hi, this is Francesco Nagari, Deloitte Global IFRS Insurance Leader. Welcome to our first March 2020 webcast. Another one will be scheduled for later this month to comment on the March IASB meeting, but today we are focusing on the late February IASB meeting, and the title of today's webcast is Annual Cohort Requirement Remains Unchanged with No Exemption Provided. The IASB approves to finalize the last round of amendments to IFRS 17. As it is now customary for many years, the agenda is structured around three items. First, the highlights of the IASB meeting, which was held last week on the 25th of February 2020. Then we'll spend the majority of the time to look at the detailed analysis that we have prepared for you regarding the discussion that the IASB held and the decisions reached. And at the end, I will spend a couple of minutes to discuss what the next steps are going to be. In terms of the highlights, the board has now completed the technical discussion, if you like to call it, and the only thing that remains to be done for them is to decide which mandatory effective date will be included in the revised text of IFRS 17. In parallel with that decision, they're also planning to assess the possibility of extending the temporary exemption from applying IFRS 9 that is being provided currently under IFRS 4 for all entities with significant insurance operations. This decision will be reached during the upcoming board meeting, which is scheduled to be during the week commencing Monday, the 16th of March. The agenda should be out by the end of this week. In the votes that were reached for the meeting last week, all of them but one were unanimous, although there were two board members absent for other business. The 12 members present unanimously approved a fairly long list of topics. So the first one is the title feature. The annual cohort requirements remains intact as it was in the standard, and the comments provided did not generate any further amendments. However, analyzing the discussion and the paper is useful, and that's what we intend to do in the webcast today to understand how it works. Second, they finalized the requirement relating the contractual service margin for insurance contracts not accounted for under the variable fee approach, with due consideration for investment return service when identifying coverage units. Then they amended IFRS 17. They decided to amend IFRS 17 to extend the application of the risk mitigation option, or as I call it, the VFA hedge accounting, to include among the hedging instruments also non-derivative financial instruments, as long as they are measured at fair value through profit or loss. Then they also decided to amend some specific aspects of the transition requirements of IFRS 17, aimed at making the modified prospective approach more easily applicable. They've also approved certain recommendations on minor amendments and other topics raised by respondents to the exposure draft. For the one decision that was not approved by the 12 out of 12, we need to look into the amendments to the modified prospective approach. Once again, this is a consequential amendment to the decision reached in the previous board meeting to introduce the option for accounting under IFRS 17 in interim financial statements. Transition has been amended, so when you are in the MRA, you can avoid assuming that you have effectively issued interim financial statements in those periods. And one board member was against that, as it was before throughout this particular topic. Okay, so that's the highlights. Let's now dive into the annual cohorts. The lion's share of today's webcast will be on this topic. As you know, the board didn't ask a question about the annual cohort application to insurance contracts in any capacity, either from all insurance contracts perspective or the ones that are displaying mutualization characteristics. And now the IASB, as you know, they like this more precise and formal language to define things, and we call the mutualization contracts insurance contracts with intergenerational sharing of risks between policyholders. In any case, the paper admitted that a lot of respondents, including Deloitte, commented, although this was not open for comment in the ED, and they believe that it is fair for them to classify all the responses in four groups. The first one is a small group, a small number of respondents that actually said do nothing. just reaffirm what is in the standard. Now that we know the answer to the question, we know that this small number of respondents is the winner. Some respondents would prefer to actually get rid of the annual cohort altogether for all contracts. A third group, which includes also my own firm, Deloitte, supported the requirements in general, but commented on how that requirement could be made work better and could be even exempted when applied to insurance contracts with mutualization features. And then there was one respondent that made up the fourth group, which said just reaffirm the exemption is not available to any type of insurance contract. So effectively, you could call it a particular hardcore member of the first group, but the IASB staff decided to classify that person as a separate group on its own right. As we know, the board approved to change nothing in the standard. That means that entities are now required to apply, as before, without exception, the annual cohort requirement to all contracts, in particular the ones with insurance contracts with intergenerational sharing of risks between policyholders. But as we know from the standard as it is written currently, there are situations where it may be possible to unlock the CSM, at least without considering the groups. And I'm going to run you through an example from the paper that shows under what conditions that may be possible, however limited. Now, in terms of analysis of the staff, I want to start by telling you about the feedback summary that they put together. They effectively noted that it's valid to accept that the response letters have now raised at least two main topics, which were not considered in the March 2019 board meeting, when the board decided not to expose any changes on the annual cohort for mutualization contracts. The first is that it is true that an entity is required to apply additional judgment if you have discretion over the split between the entity share of the returns from the underlying items and the share that goes to the policyholder as a whole. And that is for from contracts that will be accounted for in different groups and annual cohorts. Some respondents observed, and the staff appear to agree with that conclusion, that this additional judgment is far more subjective than other judgments required by IFRS 17. The second topic is that the subsequent measurement of the CSM of individual annual cohorts requires two forms of allocations. The first one, the one that is in the slide B, Roman 1, is done to the individual annual cohorts that give rise to those cash flows. Those cash flows are the ones that are not dependent directly from the changes in the value of the underlying items. So these are the fixed cash flows. The other impact on the subsequent measurement of the CSM comes from the changes in the amount of the entity share of the fair value of the underlying items. That is the one that is done across all annual cohorts that participate in the same pool of underlying items. So when you have the mutualization characteristics. So to do that, with these new topics in mind, the IASB staff took the example that was used in March 2019 and elaborated it further. So let's rehearse the example characteristics based on the paper. We're looking at a portfolio of contracts which are sharing under the same fund of underlying items containing fixed rate bonds. And the key fact patterns to bear in mind are we have two groups. The first one is issued at time zero. The total premium received is 10,000 currency units, duration is 5 years, and the market rate, as well as the rate generated by the fixed rate bonds purchased with the collection of the premium, is 5%. Second group issue T1, time 1, is larger, 15,000 currency units, same 5 years, but obviously later. And now the market rates have dropped. So we moved down from 5% to 1%. And again, the bonds are bought at that point with a yield of 5%. In both group of contracts, the policyholders receive 80% of the fair value returns, with the entity having discretion over the timing and allocation across policyholders. So pretty much a VFA fact pattern. Now, scenario 1, the table below illustrates the application of paragraph B68 preventing Group 2 from being depicted as an onerous group because it reflects the sharing of the cash flows between both groups of policyholders. So this is where at least a positive message, I think, can be read in this paper, because it shows us that the application of B68, as it is written, it does at least create an intergenerational cash flow that in this example you see in the blue box at the bottom of the table is for 907, completely reversing what would be otherwise a loss-making group of contracts. But let's navigate through the table from column A to column E. So column A shows you the initial recognition of Group 1. You can see the market rate, the policyholder share on the returns, and the 4.075 is just the compound interest arising from effectively that particular 5% distributed back to the policyholders at 80% rate. Then you can see at the bottom of the table that you have fulfillment cash flows of 9,567, a CSM of 433, which is effectively the coming from the 20% you're retaining. And then you got insurance contracts and the underlying items at the same value on day one. You then remeasure the same group 1 year later when market interest rates have now gone down to 1%. You're still projecting the crediting rate given that you got the asset to pay for that, but your fulfillment cash flows now are discounted at a different asset-based discount rate, and so they go up to 11,734. But so does your CSM, because you're now sharing also the fair value gains that are going to be available to you from the bonds. And so the bonds are now at 12,265, and so is the insurance contract when you add together fulfillment cash flows and CSM. Column C is the transition column. So this is the one that shows the two groups if there was no mutualization, so before the application of paragraph B68. And again, you see that in this instance, when you have the new market rate, you start taking some decisions. The crediting rate is not going to change. It's going to go to 2.004%. Because you're going to share a blend of bonds that yield 5 and 1%. And before you do the B68 adjustment, you have a loss-making group, Group 2, because you are effectively paying off more than you earn, 1% from the underlying items, if you consider them separately, of 759, which by convenience the IASB and Deloitte has decided to leave on the same line as the CSM. So treat it for the moment as a negative CSM on a temporary basis. But then you have the intergenerational cash flow sharing or the subsidy, because all the policyholders are in agreement by contract to share the total return of the 5% yield and the 1% yield bonds. They are going to get prospectively 2.004%. Here you go, you got effectively the subsidy of 907 currency units moving from Group 1 to Group 2. And so if you move then to column D, here you can see that after application of B68, both groups are profitable. The first one still ended up being more profitable than the second one and is the same position as it was before the recognition of Group 2, 531 currency units of CSM, and the same fulfillment cash flows. But the Group 2 is now profitable. The fulfillment cash flows have gone down because they've received more inflows from the other group of policyholders, and the CSM as a result has been increased to a positive 148 from being a negative 759. When you add the two together, you would have the sum of fulfillment cash flows and CSM in column E. But that's the point when the IASB staff says, actually, we can't go there because we are going to lose the fact that Group 2, although profitable, after the subsidy, is less profitable than it would be Group 1. And so given that those are numbers that feed into revenue and profit at different periods, we got to keep the annual cohort in place. And that is the part that is the bad news for those who have argued for a less compelling application of this requirement. Let's shift to the second scenario. So we got the same portfolio, but now what we do here is the increase of the policyholder share for the first group to 85% before issuing the next group of contracts. So in that period, we decided we're going to have a more generous view on the sharing, and we increased from 80 to 85%. So when we look at column B, which is the difference between the previous table and this one, now we can see that the fulfillment cash flows has gone up and the CSM has gone down within the same total carrying amount for insurance contracts, the same 12,265. Then we redo again the B68 before and after, but this time also with an additional fact pattern, which is as we issued the second group of contracts, we change our mind once again and move back to 80%, given that we are now relying on a component of the underlying items which is yielding much less than the original component of underlying items yielding 5%. So in this instance, although we end up having the same positive and negative CSM in the two groups, the subsidy that goes across because of the previous decision for 1 year to be at 85% is greater. And so here on the column D, we can see that group 1 doesn't have the CSM of 531 as before, but now has got the 398 as it was when they had an 85% retrocession rate. And the cash flow, the subsidy, has now increased the CSM of group 2 above the 148 that was there before, and because of the reallocation has now gone up to 280. The sum of the two together still matches the same figures in the previous scenario. So what we have here is that the change in assumptions in 1 year has effectively had an impact on the cash flows and the CSM of the two groups, even though the total remains the same. In the example, the assumptions that have been used can be described as something that can be presented in one or two ways. One is the fact that the existing underlying items are calculated without anticipating the effects of any new contracts, or, and that is my preferred way of saying it, there is an expectation of new contracts and the resulting underlying items and the expected subsidy from the existing policyholders to the new policyholders will have to be factored in the calculation. That means we can see the different generational policyholders helping each other. The IASB staff in the paper observed that entities have to make this assumption in order to measure the existing contracts at the reporting date, and that is regardless of whether the existing contracts are divided into annual cohorts. So that means that IFRS 17, paragraph B68, requires comparison of existing contracts as a whole with the new contracts in order to identify the marginal contribution of the new contracts. Then the IASB staff then moved into a third scenario to complete their proof as to why there should be no change. And that is where in this table you can see that we got the similar things as before, the 80, 85 and 80, but then at the end of year 3 we have another change, which is moving to an 83% retrocession rate for the underlying items. So what is showing here is that there is a possible approach which has been explored in this paper by the IASB staff to allocate changes in the amount of the entity's share of the fair value of underlying items across annual cohorts that share in the pool of underlying items. So effectively, what they're showing us here, as you can see in column E, is that I no longer have, when I change my retrocession rate at the end of year 2, I can change the fulfillment cash flows as a whole, and then allocate based on the opening, effectively on the balance that existed before that change of assumption. So what we have done here is the loss of shareholder profit for the 3% that is now being decided to be granted to the group of policyholders 1 and 2 reduces the CSM of the two groups in proportion to the balance. And that means that irrespective of whether we have the two annual cohorts for the calculation, so the calculation is effectively done across the portfolio. The fulfillment cash flows is what determines the amount, and then when you have the amount done across groups, ignoring the annual cohorts, you allocate it back to the annual cohorts based on the respective relative balances. In the example, this would be possible, the staff observe, because there is only a set of cash flows that comes from the participation on the underlying items. If there were fixed cash flows, for example, claims and guarantees, that would affect annual cohorts differently, then this approach will not provide useful information on the profitability of different cohorts, and the calculation as a portfolio will not be possible. Again, to highlight the fact that although it is technically possible to do the unlocking at a portfolio level with an allocation proportionally back to the annual cohorts are still required, and even that calculation may not always be possible if fixed cash flows create a different impact on different groups of contracts. In conclusion, the staff believe that the key benefits of IFRS 17 as it is are the transparency and the timely information about loss-making contracts, and that those two benefits can only be preserved, in their opinion, if you keep the standard as it is. They also observed that some board members concurred that information about the effect of financial guarantees is particularly important in the current economic environment, given the low interest rates that currently exist in a number of jurisdictions. If there were changes in fixed cash flows, such as financial guarantees, that affect different cohorts in a different way, then these cash flows could make individual cohorts onerous, even if the portfolio as a whole remains profitable, and that should be demonstrated in the financial statements of the insurer. The staff also indicated that it's important that the application of annual cohorts requirement is kept, because it also gives to users of financial statements information about the trends of profitability of the relevant groups of contracts. So we are at this juncture, and probably for the last time, I'd like to explain where we would have liked to convince the IASB to go in Deloitte. We acknowledge that this is a very material proportion of the insurance contracts currently in issue, and that, in our opinion, the existing guidance doesn't result in a consistent accounting treatment when you have these mutualization characteristics, particularly when you have to adjust the CSM for changes in fulfillment cash flows. Our proposal was to amend IFRS 17 and clarify that the entity will adjust the CSM at the level of a single combined risk-sharing portfolio. The CSM would still be adjusted in proportion to the changes that are determined at the level of the risk-sharing portfolio, effectively similar to what was done in column E in the scenario 3 of the example of the IASB staff, but we were arguing to do that all the time. We also had provided an example, and if you look at the paper, you'll find the same example is being quoted in the IASB staff paper. This is where you have effectively like a risk-only portfolio of contracts, and then the underlying items are like a portfolio of mutualized motor insurance contracts. One group contains the loss-making contracts, so you got the effect of claims. But we argue that if you take the risk-sharing portfolio as a whole, you could calculate a subsidy that is effectively the penultimate line on the table that will actually bring back all the 10 groups in this example, to a CSM of 60, allowing you to demonstrate mathematically that you can actually calculate the whole thing in one go at the portfolio level. We believe that this can be done by adjusting paragraph B112, but we know that this is now history, and we're going to keep B112 as it is, given the decision that the IASB has reached last week. Okay, enough of mutualization. Let's now move on to the second most important topic from last week's board meeting, the contractual service margin attributable to investment services. This is particularly focused on the CSM attribution for those contracts that are not in the VFA accounting model. Now, let's start with the concerns raised by some of the respondents about the definition that the IASB wanted to introduce to do so. The first one is that the criteria for when an insurance contract may provide an investment service appear to be unduly restrictive. In the view of these respondents, the criteria did not capture economically similar insurance contracts that provide both insurance and investment return service. But that cannot be surrendered or transferred, which is one of the key conditions in the rule-based definition. For example, a deferred annuity during the accumulation phase. This definition also has a degree of operational complexity that is introduced by the proposals, in particular for contracts in which the investment return service is considered to be provided only during a part of the life of the contract. Given the analysis, the staff was prepared to set out a series of recommendations, all of which have been approved unanimously. So let's go through them all in this and in the next slide. The first one is that the board approved to finalize the proposed amendment and to require the identification of coverage units for indirect par contracts, considering both the quantity of the benefits from investment return service as well as insurance coverage. Second, they approved that there will be a confirmation that the specified criteria that are being introduced in the standard to define what an investment return service is will be amended to avoid the reference to a positive investment return, and instead they will just refer to an investment return. That's a good change. Thirdly, they have agreed to require that an entity will have to include in the fulfillment cash flows within the boundary all the costs related to investment activities to the extent that the entity performs such activities in order to enhance benefits from insurance coverage for the policyholder, even if the entity has concluded that the contract does not provide investment return service. So this is actually a very important clarification to help a number of our clients who have been asking us, and I'm sure our colleagues in the other firms, whether there is a basis to include these type of cash flows in the fulfillment cash flows calculations. And now the answer has been given and is positive. Then the board also agreed to finalize the amendments in IFRS 17 for disclosure purposes, asking the introduction of a footnote that provides quantitative information about when the entity expects to recognize in P&L the CSM. Effectively now is a reaffirmation of the previous requirement. And second, to disclose the approach used to determine the relative weighting of the benefits provided in contracts that offer both insurance coverage and investment return services, or insurance coverage and investment-related services. That's the key subtle distinction in the wording between the indirect par and the direct par contracts. And finally, they have decided to confirm the addition of the definition of insurance contract services to the Appendix A, but not to change other terminology used in IFRS 17, in particular not replacing coverage with service in the term coverage unit, etc. Moving then to the third main topic around the VFA hedge accounting, consistent with the feedback that was received during the development of the exposure draft, some respondents suggested that the board amend IFRS 17 to permit an entity to also apply these VFA hedge accounting when the entity has selected the financial instruments measured at fair value through P&L to be hedging instruments, even if they are not derivatives. Those respondents generally expressed the view that the board has not adequately explained the reasons why the preclusion of these type of hedging instruments would be appropriate and conceptually justifiable in the context of the risk mitigation option that applies to the VFA. And in particular, why not non-derivative financial instruments measured at fair value P&L? There were a number of practical points. The first one is that often insurance companies use a combination of derivatives and non-derivative financial instruments for hedging, for example, fixed income securities, to mitigate the risk coming from direct participation features. They also may decide that they can mitigate financial risk using either derivatives or non-derivatives financial instruments, and those respondents explain that when you use non-derivatives, sometimes it's less expensive than using derivatives, so there is a cost-benefit analysis here going on. Also, there is an availability point, which is in some places you don't have derivatives, but you can actually hedge with non-derivative financial instruments, so that's another practical point. Given all that, the staff noted that the feedback was relevant, and although when the board went through the comments received from respondents to the hedge accounting exposure draft in 2010, which commented on the same point about allowing non-derivative financial instruments to be hedging instruments in IFRS 9, and decided not to give that permission. In this instance, for the VFA hedge accounting, they feel that there is a better and different ground for that concession to be granted, because effectively the financial instruments are measured already at fair value P&L. There is an accounting mismatch that may arise if you don't actually allow them to be hedging instruments with the VFA liabilities. And so for all these reasons, the recommendation was to make that amendment in IFRS 17 and allow that in addition to derivatives and insurance contracts, also hedging instruments will be allowed to be counted as a component of the hedging relationship under the risk mitigation option. Moving then to the part of the decision reached last week, which maybe can be called a sundry or sweep issues. The first one is on the additional reliefs, permitting prospective application of transition requirements. There were 17 topics, but only 3 topics, 3 aspects of the transition requirements were effectively taken up for decision. So I'm going to talk about those. You can see them. First one is to add the modification to the modified prospective approach to permit entities that apply the accounting policies for not changing the IAS 34 treatment of insurance contracts for interim financial statements to apply such policy prospectively at transition date. So that means that it's almost like pretending that when you have reached the point of impracticability, which is not transition date, is a bit further back, for those periods you assume that you never had to be producing interim financial statements. But for the full restated period, you got to do it. Second is the extension of the modification in the same modified prospective approach and also in the fair value approach to permit entities to make an assessment on when an investment contract is an investment contract with DPF, using information available at transition date rather than at inception of the initial recognition date. And thirdly, they have agreed to amend the proposed modification in the MRA for insurance contracts that are held when underlying insurance contracts are onerous. This may or may not be a good news for you, but this decision is to say that if you are in the modified perspective and you got these reinsurance contracts, it is assumed that they were purchased after the insurance contract were issued, and that means that you cannot recognize on transition a loss recovery component for the reinsurance contracts you're holding. Again, that is if you are beyond the impracticability point and you are trying to restate the reinsurance contracts based on the modified prospective approach. In terms of the minor amendments, there were a number of them, but in the interest of time, we have decided to comment only on 3 of them in this webcast because we felt that they are the ones with a greater importance and impact on our clients. So the first one that I wanted to mention is actually not to make a change to the exposure draft, but to explain something which was brought up quite extensively by a number of comment letters and other outreach activities. It's the editorial correction to paragraph B107. Some of the respondents have viewed this amendment as a major change rather than an editorial correction because they believe it is departing from the correct application of how the VFA assessment should be done. This text effectively makes it clearer than it was before that the assessment has to be done at the individual contract level. But people are saying in their letters that this is not what they read in paragraph B101, and they would have actually interpreted the requirements to be applicable at the group level, at least in line with paragraph 24. The board is of the view that both paragraph B101 and B102, which require the assessment using the entity's expectation at the inception of an individual contract, is clear enough, and that requirement needs to be consistent, and so the editorial correction is necessary to remove an inconsistency that, if it is kept, would then lead to disruption in the longer term. So they are confirming that they want us to effectively revisit the way we have done the VFA assessment to move it to an individual contract level basis from now on. The second point that I wanted to talk about the minor amendments is the one about amending paragraph B96C. This was actually an actual amendment from where the IASB was in terms of the exposure draft, not as extensive as Deloitte was hoping for. You see in a moment I'll talk to you about the proposal, but what we have here is the recognition that it's true that the changes, the experience variances from investment components in the contracts that are outside of the VFA could relate more to the insurance finance income or expense line item than to the insurance service result, and so perhaps it shouldn't be part of the CSM unlocking. The amended B96C already did that. What they have agreed last week is to extend the same removal of that for the investment components that relate to loans to the policyholders that may become payable in the period. So effectively the reversal of an investment component. It's a very minor amendment, still positive, I've got to say, but we believe that it would have been so much better if B96C had been deleted altogether, and that's what we had recommended on the grounds that the only variable that creates the experience variance is the fact that you are collecting an investment component that would be paid otherwise with the level of certainty at one point in time, and so the difference is entirely due to the time value of money. we were not good enough to persuade the IASB to do that change. So we are going to still have a relatively complex B1960 to implement in practice. And then the last of the three comments I wanted to run you through is the one about paragraph 28. Again, another one that we commented on in our letter. Paragraph 28 is amended to give emphasis to the initial recognition date based on the criteria of paragraph 25. But that amendment is not carried across into paragraph 22, which remains based on issue date. And so that means that if you have issued forward-starting profitable insurance contracts, when they become initially recognized, that initial recognition carrying amount doesn't go into the group of contracts at the time you have initially recognized the contract. Instead, you have to backtrack it and put it back into the group of insurance contracts however many years before was created in your financial systems, because that is the year in which the contract was issued, technically speaking. And so that is obviously leaving groups open whenever you have this type of contracts with forward-starting coverage. And that creates a whole series of operational complexities. Just to name one, the recalculation of the locked-in discount rate on the relevant group. There were other topics raised by respondents to the amendment of IFRS 17 in the special draft, and we decided to comment only on a few of those decisions in this webcast because we thought that they were particularly important. So I picked these three. The first one is on policyholder tax. The board has approved an amendment to paragraph B66F. This is one of the paragraphs that says what should not be in the fulfillment cash flows. The amendment will result in an entity applying B65M, which is the one that explains what should be in the fulfillment cash flows, to include in the fulfillment cash flows the income tax payments and receipts that are specifically chargeable to the policyholder under the terms of an insurance contract. So that's the amendment. So hopefully these will clarify a bit better what the fiduciary nature of the tax payments that an insurer may make means in practice. This specifically chargeable to the policyholder appears to be quite unambiguous in my personal opinion. The second one is about the guarantees under the VFA. This is not a change, it's a retention of the existing text. So B113B will be retained as it is, whereby the requirement to adjust the CSM under VFA for the changes in the effect of the time value of money and financial risk not arising from the underlying items. And then finally, on the conversion options, a number of letters were asking for either a clarification of the standard or, more likely than not, the publication of some educational material, in particular for options that change the nature over time of the contract due to policyholder exercising an option. That request has been rejected, so there's going to be nothing either in the standard or in terms of educational material. We'll have to figure it out by ourselves. The IASB won't help us. Coming then to the last of my slides, the next steps. So I've already mentioned in a couple of weeks we'll find out what is going to be the effective date and also what is going to be the extent of the temporary deferral of IFRS 9 application to entities with significant insurance operations. It's going to be in the week of the 16th of March. The agenda should be coming out by the weekend, so stay tuned. We will let you know through social media that that is coming. At that point, there will also be a paper seeking the permission to ballot, which means that the standard amended with all the new requirements will be out by the end of June 2020. That was my last point. As I land on the final slide of the presentation, I just would like to remind you that we are ready to help you. And you can contact us and follow us using one of those channels at your pleasure. And with that, I'd like to stop the recording and open the floor for any